Good morning, Jags. This is Fahad. Today is Tuesday, October 20th. Let's get started. Today, I have Chronicle here with me, and this is episode 6 of the series we have been running on Jaguar Media called Chinese Tech Demystified. And in this episode, we are going to cover an interesting name that I particularly find very interesting because I like the space overall. And the stock is called OneConnect, symbol OCFT. Hi, Chronicle. How are you doing?
Morning, Fahad. Doing great. It's been a while since we did a Chinese Tech Demystified episode. Always nice to do one of these.
Yeah, absolutely. I always look forward to these because I feel like, as I've said before, I always learn so much from these, and it's interesting to get the perspective from somebody who's already in Asia, such as yourself, and is close to a lot of the things that are happening there. Okay, OneConnect. Interesting name. Tell me about it. High level thoughts. What is it? What does the company do? And what's happening here?
Sure. Let's go to the next slide. So OneConnect is a 2015 spin-off from Ping An, which is a massive conglomerate in China. It used to be Ping An's fintech arm, though one could argue they still are. But what the company does is they provide cloud-based fintech platforms and solutions. It's comprehensive, covering everything from sales, marketing, analytics, risk management, operations, efficiency management, and IT infrastructure. But unlike, say, Alibaba's Ant Group or Tencent's WeChat, what OneConnect focuses on is supporting corporate financial clients rather than individual consumers. They're essentially a monopoly in banking because they serve all of China's major banks, 99% of its city commercial banks, and 53% of its insurance companies. However, it comes with a caveat because the Ping An Group's in-house businesses represent by far a majority of their revenue. Now, if we look at pages 2 to 3 of our note, I have a breakdown of OneConnect's offerings. To summarize, they provide banks with tailored mobile banking apps. They provide platforms that connect lenders with SMEs. They also provide complete management tools that help insurance companies recruit and train agents. There's also analytics, risk management software for banks. They also have solutions for auto insurance, which is a fast-growing industry in China.
It's really sounds like it's really a one-stop shop for all fintech solutions for enterprises,
Mhm.
banking sector, as well as the retail clientele, isn't it?
Yep. There's no one else to go to basically if you need fintech solutions.
Yeah, I mean, in terms of it, I'm looking at your write-up here that will also be part of this presentation. It will be uploaded on Jaguar Media website. But looking at just a breakdown of the services the company provides into 6 categories, the digital retail banking, we are well aware of that, the SME financing and services, the insurance sales and management, retail banking, auto insurance, SME banking risk management. It's really one-stop solution for a lot of services. And I think that's the part, one single stop solution for a lot of the largest, category of banks in China that really gets my attention. Moving on, tell me about this one right here on this slide.
Sure. So you may have noticed the huge slowdown in revenues. This is not a pure tech company. It is exposed to cyclicality. So it's not the company's fault that the pandemic came along and slowed everything down. But yeah, it is a valid concern. But as we can see, revenue growth has been slowing since 2017 from 143% all the way to 17% recently on a trailing 12-month basis. But I have to say it's not completely correct to assume that the remaining addressable market is limited due to OneConnect's monopoly in China. Because first of all, OneConnect employs a strategy of giving out hooks at low prices or even for free. And then once a customer becomes more accustomed, only then does the company follow up by offering add-ons at pay-as-you-go pricing based on usage and volume. So for example, every time a customer does a database search or each time they perform a credit check, OneConnect charges them. And so What this means is that the customers gained in previous years, they can still contribute meaningfully to growth. According to filings, their existing premium customers purchased 2.7 new products in 2019, 3.0 in 2018, and 3.2 in 2017. This translates to a net expansion rate of 119% in 2019, 224% in 2018, and 167% in 2017. What this means is that existing customers are more than doubling their contribution to revenue each year. So that's the first point. The second point, looking at pages 3 and 4 of the note, we cover all of the expansions that OneConnect is making outside of China. To save time, I won't go into all the specific details. It's all in the research note. But in the last 12 months, they've managed to secure roughly 50 clients across 10 countries in Southeast Asia. These clients are all some of the biggest banks and institutions in their respective countries, so it's not small potatoes. Right now, the next biggest catalyst for this region would be an anticipated digital banking license approval in Singapore. If that happens, OneConnect already has a local partnership and base of operations in Singapore to take advantage of that. And then if we look elsewhere, the company recently launched digital banking in Hong Kong. They formed partnerships in Japan and South Korea. Outside of Asia, they've signed a cooperation agreement with FinLeap, which is a fintech software provider in Europe. And they've also established operations in Abu Dhabi to begin helping the Middle East build a fintech ecosystem there. So not only is OneConnect trying to corner Asia, they're also beginning to expand to EMEA. And now the last bullish point is if we look at OneConnect's recent commentary, management has attributed the bulk of the 48% year-over-year revenue growth in Q2 to the pandemic forcing customers to upgrade their IT systems and save costs. Like if we look at page 5 of my write-up, management said that their operations support revenue went up by 148% because their customers have been rethinking their IT strategies due to the pandemic. Specifically, the two key products that they've been seeing a sharp increase in demand are the AI customer service and the roadside assistance modules. So if the volume starts to recover for their other segments, this one's going to stick as well. So that's future growth right there.
On your first point, it is important to emphasize to the audience that while the revenue growth may have decelerated from hyper growth rate of over 140% year over year 3 years ago to now about 17% year over year based on trailing 12-month basis as of the second quarter of 2020, the net expansion rate for its existing customers was 119%. So that's exactly the point that you made, that there's significant amount of upsell that is taking place to the existing customer base, and that continues to be the growth driver of new services. I particularly also find this very exciting about your second point regarding expansion plans outside of China with the Singapore license that is still expected to happen for digital banking at any time. C Limited is another company that we have been eyeing that catalyst for quite some time, and that stock has done remarkably well over time. What percentage of total revenues for OneConnect is outside of China right now?
So at the start of the year, it was low single digits. And they're hoping over the next couple of years, as they build out operations, they're hoping it becomes between 10 to 15%.
And so up until a year ago, basically that means they didn't have any clients outside of China. And now it appears that based on your write-up, they have 50 clients. These are commercial banking clients, institutional clients in 10 South Asian countries, and all within the last 12 months or so. And naturally, this will continue to expand and the revenue mix will change geographically with more and more revenues coming from outside of China. And then after that, once they've gone after the big markets, they will then start to do similar kind of upsells to these customers, then similarly to how they have been doing in China. And that's really the core of this bull case rather than just focusing on top line revenues. It's the overall opportunity the company has to grow outside of China into other South Asian countries and continue to do these partnerships. Great stuff. And then moving on. Now, this is a sticky point for the bears here, which you discussed as well. What's going on with these operating losses? Rather significant here, aren't they?
So first off, like a lot of other US listed Chinese tech names, OneConnect is a heavily loss-making company, despite enjoying high gross margins. It's almost become customary for a Chinese tech company to lose money. It's simply a reflection of how competitive the market is and the amount of pressure there is on these companies to grow. That's all it really is. Looking at this top right chart, the loss has narrowed slightly in recent quarters, but this is mostly due to delays in product launches. Management insists that breaking even is a midterm target, but realistically, we have to attribute a lot of this improvement to the general macro slowdown from the pandemic. And so rather than believing management, it's better to be on the conservative side and expect the losses to expand again once the Asian economy picks up. Additionally, Ping An, the former parent of this company, they're also helping to eat some of that marketing and development costs. But coming back to the point, are these losses a worry? Not really, because the high SG&A expense is proof that they're rapidly laying foundations for growth. If we look at the top line, revenue from transaction volume continues to see solid growth at 391.3% year over year, and implementation sales also surged 71.5%. On top of that, gross margins are 36%. And so if gross margins are positive, I don't think this is a worry. So if we assume the recent contraction in a couple of other segments like loan origination volume and risk management, which make up 50% of revenue, if we assume that this is just a temporary drag from COVID-19, then we have to conclude that growth will likely be back on track once macro problems are behind us. Now, moving on to the second point, OneConnect still relies too much on Ping An. Believe it or not, Ping An is still heavily involved in OneConnect's R&D and marketing, among other roles. In fact, this quote unquote strategic partnership is contracted to last till 2030. And on top of that, if we look at the bottom right chart, there is still an over-reliance on the Ping An group as a customer in China. So it's almost as if OneConnect has never left the nest. This is what the bears are pounding the table on. Maybe the one bright spot has been Lufax's recent entry into consumer financing, which has helped OneConnect. But even then, Lufax is technically backed by Ping An as well. Now, part of this is due to the nature of China's financial industry. Like, even if you tried your best, you couldn't really get away from Ping An. Like, that's not OneConnect's fault that China is this way. But that said, it is slightly worrying to see third-party revenue contribution trending in the wrong direction despite growing 28.9% year over year. But going back to the recent earnings report, a lot of this, again, can be attributed to weak loan origination and risk management volumes. Because even though Chinese macro indicators continue to show V-shaped rebounds, the pandemic has still done a lot of damage under the hood. A lot of OneConnect's third-party revenue are SME related, and the recovery for SMEs is going to take time relative to the giants. So this part of the bearish argument does have some weight, but the other part of this argument, like the over-reliance on Ping An when it comes to R&D and marketing, what I would say to that is I think there's nothing wrong with leaning on Ping An's expertise, because this relationship is what gives OneConnect the biggest advantage over all the competitors. I think it would be silly of the company to handicap itself by not capitalizing on this partnership. Like, why would they want to do that? in my view, I'd be more concerned if they were to suddenly break off that relationship. That to me would be a bigger risk to the stock.
Well, let's look at these 2 points from my perspective on both of these bearish arguments. On the first one, Asia is a very large continent, and the company has been up until 12 months ago entirely dependent on China for growth, and now they're starting to emerge out of that. Less than 10% of the company's revenues come from outside of China. I mean, all of that is not going to happen magically. It's going to require higher SG&A expenses to build these relationships with commercial banks and institutions to expand and then go after new markets that are underpenetrated, whether it's Indonesia, Singapore, Thailand, Hong Kong, Dubai, and all the other countries that you mentioned. So this SG&A expense line item does not bother me as long as the top line revenue growth continues to remain strong, which is clearly the case here. And the second case about the bear arguments about Ping An, yes, too dependent and too reliable, but that is precisely the parent company, Ping An that is, which is also providing this R&D, which is how the company has been able to add new kinds of products to its portfolio mix to service to the very customers that become long-term customers. And we just talked about it the earlier part of this presentation, where their overall net retention rate continues to be up more than 100%. And I think so there are benefits of this partnership. And I understand this will last until 2030, but maybe, going away from that completely at the time when the company is still, expanding its ground footwork into so many other nations would actually fire back. And so I think this relationship is not really a bearish argument. This relationship is rather working in favor of the company rather than against it. So that would be against the bearish second argument over here. Now, taking a look at technicals on this chart, now you believe that the stock can be, gradually accumulated at this area, but you want to be mindful that if you're looking to buy this at a real support, that support is still about 10% below where the stock is trading right now. And so we wanted to come to this presentation with the view that gradual accumulation incrementally is what would be the best way of positioning into this stock rather than just going all at once. Is that correct?
Yep, I think there's a lot to like about the company due to its monopoly in China and adoption potential of the fintech industry across Asia. Like this company charges based on volume, and Southeast Asia is rapidly growing. And with that, when commerce grows, volume will grow as well. Technologically, this company is way ahead of its competitors, even if it's because of strong dependency on Ping An. And I think Asia is theirs for the taking, on top of efforts to grow in Europe and the Middle East. In terms of Chinese commercial fintech plays listed in the US, they're quite scarce, like not the retail-facing kind. That said, there's been some sustained downward pressure on the stock because of decelerating revenue in the near term, setbacks in third-party revenue contribution, which is mostly due to slow recovery in SMEs. These problems aren't structural, and most of the headwinds are macro related. And so we can expect OneConnect to see loan origination and risk management volumes recover alongside the economy. But it's unlikely that things will turn around right away. Therefore, currently, yeah, this is a good spot to accumulate, but not to go in full. So I would scale in slowly. That would be the right move.
Stock is up 5% today on my screen. It's trading at $20.75, and the support is at 18, but right here around 20 as well. There's a lot of attachment to this level, looking at the VOP congestion level. So, this thing was as high as $28, $29 per share back in July, but here it is, the stock having corrected by more than 30% since then. And so somewhere between 18 and 20, it remains a very attractive entry in my view, or even out here at 2075. But important thing is that, as you and I both agree, scale into this position gradually rather than all at once. And I think that would be the best way to move forward. And ultimately, I would look for a new 52-week high in stock over time. All right, fantastic stuff as usual. I learned a lot from this presentation chronicle. We'll be monitoring this stock very closely. Hopefully this was enjoyable to everybody, and we'll see you next time. Thank you.